Right, now let's focus on the next part of the question. We are doing mock 3, question 1, and we are on joint venture. Right, so let's focus on joint venture, which is question B. Right, so we've been asked to use Exhibit 3, discuss with the calculations how the investments in Rocket company, right, and the sale of the property should be accounted for in the consolidated financial statements of the Luna Group in the year ended 31st of March 2016. So this is an investment in this Rocket, company. So here, first we still don't know what is this regarding. We don't know whether this is a subsidy. Investments can be many types. It can be simple investment, it can be an associate, it can be a subsidiary, and also it can be joint venture, it can be joint operations. So 1st April 2014, that is 2 years ago, Luna Company and an unconnected third party established a joint arrangement. Now things are getting clear, right? They're saying they entered into a joint arrangement. Chapter 14. There are two types of joint arrangements are there. One is the joint operations, and the next one is joint venture. Right? Joint venture is done through a separate entity, isn't it? Done through a separate vehicle, in a business vehicle. So we would only have the profit share, right? But joint operation, each and individual assets and liabilities, like we are, it's simply like we're consolidating. Everything that our share would be added to our balance sheets figures, right? That's the rough brief on that. So they're saying it's a joint arrangement involving a creation of a joint venture. So the examiner has made it very clear. Here we have a joint arrangement. The type of that joint arrangement is a joint venture in this company on 1st April 2014. Now let me pause here for a second. Let me make use of this opportunity, quickly get you into the joint operations, joint venture. And then this is the chapter 14, joint venture. I'm going to just quickly glance them through for you, right? So it's much easier. You understand them better, right? So when you deal with the joint ventures, right, where a separate business vehicle is set up to run the business, right? That means you do not, the would investor won't own any assets and liabilities. He would only own only he would have the rights for the net assets, right? So it is the business entities, it's the separately set up joint venture entity would hold the rights and liabilities for it, for that assets and liabilities. It's not the investor would not own anything there, right? So if you think of a joint venture, say for example, if you are the parent company, you have invested in a joint venture, right, and setting up a separate business, and with someone else, you have invested in a joint venture. You set up a business with someone else together, and in your own separate financial statements, you have made an investment. So that investments could be treated at cost, or it can be at fair value, and also it can be using equity method as described under IAS 28, right? So we can use any of them, right? Where a joint venture has no subsidiaries, the equity method would be used. That's fine with this individual financial statements. But when it comes to the consolidated financial statements, when you treat a joint venture, what is expected from us to apply the equity method exactly the same way that we treated associate. Using IAS 28, we would do the same equity method to measure the joint venture in the consolidated financial statements. I'll just quickly show you where that it would appear in the balance sheet. This is example of joint venture. We have calculated it. We did this example. So cost of investment in the joint venture, and then the plus post acquisition profit of the joint venture. This would the figure that would appear on the balance sheet. Now, the pro forma on the balance on your presentations on the balance sheet, investment in joint venture would be treated shown as a non-current assets after the intangible at the bottom. And then in the profit and loss account, we would have one line, right? The share of profits, right? Share of profits of joint venture, right? It's similar to associate. That's the only thing that you need to make note. Right now we have made note of this simple. That's the only thing that we have. Now let's take these questions on. Now let's read this question. Now we know we need to treat joint venture, and if it is treating joint venture, we need to apply equity accounting method, right? That means for the balance sheet, I need to know what is the investment in the joint venture, carrying amount, right? How can I start with? I need to first know what is the cost of investment in joint venture, and then the post-acquisition profit I can calculate, and from that I would be able to find that figure. The amount that should go to the profit and loss account should be my share of profits of that joint venture, right? That's what I just need, two lines, equity accounting method. Now that's fine. Now let's come back to this. Now they're saying each venturer paid 6 million in cash to the newly created entity, right, of the rocket company in exchange of 50% in equity shares. Now we could see this here. So each of the joint venturer have their percentage of ownership, equity interest is 50%, right? So they're jointly controlling them. So it's a joint venture, not associate here. Two people getting together, jointly controlling and business. So it is not this is not a associate, right? So this is a joint venture, right? So we know in a joint venture, we were told using exhibit, we are Luna company. As a Luna company, we have invested in the joint venture. So we need to only worry about our books, right? So I need to first calculate for the 31st of December 2016. I know for this date, I need to in order to find out how much is the joint venture carrying amount on this date, I need to first start applying the equity accounting method. So first of the equity accounting method, I need to know the cost of investment in the joint venture. What was the cost of investment in joint venture? I purchased on 1st April 2014 and I paid 6 million. That's my first, right? The cost of investments here, it was made on 1st April 2014, right? 1st April 2014, the amount I've invested here, right? The amount I invested here, it is 6 million, right? The amount I invested here, which is 6 million there, right? That's done. And the next one here, with respect to that, and so that's done, right? And amount I invested here, it's the 6 million there. So all I just need to find out now, what is my share of profits, right? Or post-acquisition share of profits, or the post-acquisition profit, right? Share of post-acquisition profit, right? Share of post, right? Share of post-acquisition reserves or profit, right? Share of post, post means after purchasing, share of post-acquisition, right? Profits or the reserves, right? Share of post-acquisition profits of the joint venture. This is what I want to find. So how do I find this? If I know the two net assets and the increase in the net assets would give me the post-acquisition profit. On that, I would take 50%. That is my investment share, right? That's how I normally do. But in this questions, instead of giving that figure, the increase in the post-acquisition profit. Now, I want to know what was the profit I made since I invested my money in this joint venture. So they're saying we made the investment in 1st April 2014. Instead, by giving you the two net asset figures, examiner is giving you another way to find the total, that profit that we made during that period since we invested. That means the post acquisition profit is being given by giving you those 2 years of profits, right? So we know that we can find the easy way or the normal way that we would find this when if we've been given net asset at the closing of the joint venture, net asset at the opening of the joint venture. Different between the closing and the opening is the increase in the profit, post acquisition profit. So what the examiner did, instead of giving that number, he's telling us, say in the next line, this rocket, the joint venture company, has earned profits for the year of 73,450 in the year ended 31st March 2015. When did we invested in this company? 1st April 2014. That means the entire profit they made for this year, 31st March 2015, we have entitled to this profit. It's we can take our share of this profit. So the whole period here, since we invested on the first day, right? This was our first day of the purchase. So the whole 1 year profit the joint venture made, which was how much? 73,000, which was 73,450. It belongs to us too, right? It belongs to us too. We would need to take our share of the profits, right? I'll repeat again. Normally, we would find these numbers by comparing the two net assets. So I would be able to find the increase in the profits, which is known as post-acquisition profit. Here, instead of giving you that asset figures, examiners giving us, listen, now it has been 2 years since you invested. Here's the first year's profit the joint venture company made, second year profit the joint venture company made. So we will be, if you add those two figures, that is your post-acquisition profit. And then the second year they're saying, and then this profit, 126,980, it was made in the 31st of March 2016. That means the second year. Right? So the second year was made in 31st of March 2016. Now, if I just highlight this date and then show you the importance of this date, and if you just look at the reporting date, was 31st March 2016. So now we know this was the period through we want to know this is a post-acquisition period, right? This is the post-acquisition period. This was the date I invested. This is the current reporting date. So all I need to know what amount of profit this joint venture made, this joint venture entity made since I've invested. I know the first year they made this much, but for the second year, even though they made a profit of 126,980, right? They made a profit of 126,980 here, but we were told from this money, right? We were told from this money, they paid dividend, right? So they paid dividend to both Luna Company and then the other venture. There's only two ventures here. Each of them took 15,000 dividend, right? So we know that, if he wants to find out what is the increase in the net assets, right? What is the post-acquisition profit? Post-acquisition profit is after, retained profit is after giving the dividends, right? So we know that in the second year, there was a dividend payment, not only for us, for the other venture too. So how much was the dividend they paid altogether? 30,000 dividend has been paid to both of us, right? That means in that second year, the profit that we made, which the venture company made, joint venture company made, is only 96,980. That was the profit they made in the second year. Now, this was the profit they made in the first year. This was the profit they made the second year. So this, if you add these two figures together, that is your post-acquisition profit made by this joint venture company. Now, this is known as the increase in the net assets or post-acquisition profit. I'll write both, right? So this is what is known as increase in net asset increase, right? This is this is the net asset increase of the joint venture, net asset increase, joint ventures net asset increase, right? So it's a joint ventures net asset, and increase in the net asset is what is known as, the post acquisition profit. This is what I was looking for, post acquisition profit. Post acquisition profit of who? Of the joint venture company, the post-acquisition of the joint venture company. How much is the post-acquisition profit now? You add these two up, and it came up to 170.40. Now, from this 170.40, the post-acquisition profit, I hope that's clear, right? So we know that's the post-acquisition profit of 100 and, yeah, I don't know why I've done this here. We know this is the post-acquisition profit, which is 140. 170, 430, that's the post-acquisition profit. And from that profit, now we know we are the joint venture. Luna Company is a joint venture. Luna Company's share, what we needed to know, the share of post-acquisition profit of the joint venture. This was the total post-acquisition profit made by the joint venture company, out of which we would take our shares. What is the Luna Company's shares? Only 50% is the Luna Company's shares. So what was the profit share, right? Luna Company's post-acquisition, share of post-acquisition profit, Luna Company's share of post-acquisition profit is equal to, simply, we just need to find out the 50%, and we need to find out the 50% of 170, which is 430. 170, 430, right? So that would be equal here, and that would be equal to 170 and 430, and that's 50%. So that is equal to 8215. That's equal to 8215. So what is this 8215 figure now? This 8215 figure, it is the post-acquisition share of profits of whose share of profits? Post-acquisition. This is the post-acquisition profit that we made, right? This is the post-acquisition profit that we have made, right? Sorry, the post-acquisition profit that we have made, right? As a Luna company has made from the uh, Luna company has made from the investing in a joint venture. This is why we wanted to find in it, or we wanted to find out, right? This was our investment, and then with that investment we would add the post acquisition profit that we had, exactly the same way like we do investment in associates. So the post acquisition profit was this 85215. So you add these two figures now, investments that you have made in the investment you made in the joint venture plus the share of the post acquisition profit, you get 6,855. So this is what is known as investment in, this is the investment in joint venture. Investment in joint venture carrying amount. Using equity method, on what date? This is the carrying amount for 31st March 2016. I hope it's clear, right? 2016. This is exactly the same. These questions also would be very helpful. They can give this kind of scenario in the consolidations accounts too. Instead of giving you the two net assets, they would give you, okay, what was the profit you made in the first year? What was the profit you made in the second year? And any dividends you need to deduct, and you add them up. That is the post-acquisition profit. Exactly this way. So now we know this figure of 6,085,000, right? It would appear in your balance sheet, right? It would appear, this is a joint venture, right? This would appear in your balance sheet as this would appear in a statement of financial position as an asset, as an investment in joint venture. This would appear there on the balance sheet, right? That's one side done. So we also need to know then what about the profit and loss account, right? This is in the balance sheet, right? So if you want to know what is the profit share, remember I said to you earlier, showed you two entries, one on the balance sheet, then the profit and loss account, right? So if you just want to know what would happen to the profit and loss account, so in the profit and loss account we have one line, in the income statement or the profit or loss, we would have one line, right? What we would have here in the profit and loss account, we would have the profit share, right? We would have the profit share of share of profits. It's not profit, share of profits, right? Parents share of profits would be much better way. We would say parents share of profits, share of parents share of profit, right? Of joint venture. This would be how much the profit during the year. So this was, if this was for 2016, which is the current year, we just need to know how much the profit joint venture made in the current period. How much the profit the joint venture made in the current period? The profit the joint venture, we don't deduct dividend anymore here, right? We have the share from the profit. Profit the joint venture made for the current period is 126,980, right? From 126,980, and then out of which we would take our 50%, right? And this figure the figure that would appear in the profit and loss account, 980, right? 50%. So this is what would appear in the profit and loss account in the current period, right? This would appear in the profit and loss account as a current period as the joint venture, profit share of joint venture. This would be balance sheet, and then this would be the profit and loss account, statement of profit and loss account, right? Consolidated statement of consolidated profit and loss account. This would appear on the profit and loss account, right? I hope this is much easier. This is not difficult when it comes to joint venture, right? Now let's move on to the second part of the question. The first part is okay. This is where that you need to be. You learned something new here, right? So what did we learn here? Right? What did we learn here? We learned that post-acquisition, in order to find the post-acquisition profit, it would be possible. We can be given 2 years of profits, whatever the post-acquisition years, profits can be given. So we can easily find what is the net asset increase, or which is all post-acquisition. On that, we take the 50%, which is the share of the our shares of the joint venture, which need to be treated. Right? I hope that's clear. That's done, right? So that's the joint venture. That's done. And now we're moving on to the second part, right? In the second part of the question, which they have saying, the March company, sorry, to 31st March 2016, Luna transferred the property to uh, a Rocket company for proceeds of 8 million. Now you see, Luna company is the parent, and then the Rocket company is the um, joint venture, right? So you need to know what is this transaction. So when a parent, right? Let me first show you these rules. Then it's much easier for me to explain, right? So here, so when a parent, this is what I want to explain. So when a parent sells to the joint venture or to the in associate, that transaction is known as downstream transactions. When the sales is made by the parent. But if the other way around, if the joint venture or the associate sells to the parent, then it is known as upstream transaction. So this rule is related to a downstream transaction. That means when a parent sells to the joint venture, right? So there is a rule with respect to that. So here they are saying 31st of March 2016, Luna company transferred property. Luna is the parent to the joint venture. So this is a downstream transaction. Proceeds was 8 million, and which is agreed to be the market value. That means we sold exactly the market value. Market value was 8 million of the property on that day, but the carrying amount of the property was 10 million. Now you can clearly say what has happened. We having that asset at 10 million and we sold it to joint venture for only for 8 million. Why we sold it for 8 million? Because that was its market value. That means it shows the asset that we have in our hand, in our balance sheet that we wanted to sell, that has impaired, that is the evidence that the market value has dropped, right? So here on the only related to the only entry related to the Rocket company that the directors have made in the draft of the consolidated financial statements, right, for 31st March 2016, was to include 15,000 dividend received from the Rocket company from the investments income. Right, they're saying that is only in the exhibit 4. Exhibit 4 is a spreadsheet that we will be doing them in a minute, right? So what we need to understand here with respect to this general rule, let me take this little bit, right? So there is a general rule that we try to learn here, right? There's a general rule that we are trying to learn here, right? Generally, when a parent sells to the joint venture, to be honest, when there is an agreement between parent and a joint venture, where there is a joint venture agreement, and when the joint venture company makes profit or loss, gain or a loss, that gain or a loss would be shared, would be recognized in the parents' consolidated financial statement, but it would be recognized by the parents only up to the parents' investment percentage. That means parents' interest share. So in this example, the percentage was only 50%. So if the joint venture is making any profit, right? If the joint venture is making any profit, and the parent would only the unrelated investors' interest share. The parent would be recognizing this. Parent would recognize these figures in his books only is investment, his share of its agreed joint venture shares, right, which was 50% in this example. So that's the general rule. That means, we say, for example, if the joint venture suffers 100,000 loss, we don't have to recognize all the 100,000 loss. Why? We got only 50%. So we will only recognize 50% of that 100,000 loss, which is 50,000, right? That is what the general rule says. So we can only recognize according to our investment interest, right? Interest that we have, interest share. But there is an exceptions to this rule. That's what we're going to learn, right? But this exception is applied only for the downstream transaction. That means when the parent sells to the joint venture, right? So when the parent sells to the joint venture, right? When the parent sells a joint venture, like in this example, parent sold the property, right, to the joint venture and collected 8 million cash. As a result, the asset was 10 million, but parents sold it to joint venture 8 million. So parents suffered 2 million loss. Parent has suffered 2 million loss, right? So this rule would apply. See, loss should be recognized. Now we know parent has suffered this 2 million loss. Now this loss should be recognized in full by the parent. So this loss, who should be recognizing them? It is not that the parent should recognize 50% of it. Parent must recognize this loss fully in its individual financial statements and also in its consolidated financial statement. Why? Because this is a downstream transaction and also there is evidence that this asset has impaired, right? If there is evidence that the asset has impaired, as a result, that is why that we have suffered a loss. In that case, parent must suffer the loss fully, right? So the full amount of the loss must be charged to the parent. It would not impact the joint venture investment, or it not impact the share of the profits of the joint venture. Nothing there. So I hope this rule is also clear for you now, right? So this amount, in when you start the pre-populated spreadsheets later, so this 2 million will be charged to the profit and loss account as an impairment loss, and under the heading of administrative expenses. That is what we would do, right? I hope it's clear, right? Have a read what we just explained, so you would get it much clearer to understand.